Welcome back. So you got a portfolio of Bitcoin, ETH, and some other DeFi positions. You're probably thinking about moving abroad, or you already live overseas. And that you've heard probably some countries don't tax crypto at all. Sounds like a dream, right? Well, it can be, but if you're a US citizen or resident, the IRS is going to follow you everywhere. And if you're not an American and you have your own home country, maybe there's a surprise waiting for you. Today, I want to lay down a complete framework on how crypto gets taxed internationally, the strategies real people are using to minimize their tax burden legally, and the massive traps you need to avoid. Let's go. Before we get into strategy, you need to understand why every country treats crypto a little differently. There's no global standard. Most of the world, including the United States, UK, Australia, Canada, and Europe, all treats crypto as property or investments, where you owe capital gains tax when you sell or even swap. In the United States, that can be up to 37% for short term and 20% plus a 3.8% net investment income tax for long-term gains. Some countries treat mining, staking, and airdrops as ordinary income, which can push you into a very high tax bracket, or you're not ready for it. While countries like UAE, Singapore, El Salvador have zero to near zero capital gains tax. And the rules change constantly. Let's take Portugal for instance. They introduced a 28% tax on crypto that's held for less than a year back in 2023. And many other regions are still figuring out the regulations. And operating in those gray areas can be very risky. Now, if you're a US citizen or a green card holder, this is the most important part of the video. The United States is one of only 2 countries that taxes based on citizenship, not residency. Even if you move to Dubai and never set a foot in America ever again, you're still going to owe US taxes on your worldwide crypto gains. The foreign earned income exclusion can shield about probably 130,000 US dollars of earned income, but it does not apply to investment income like crypto. While foreign tax credit might help you if you pay taxes in another country, it won't help in a zero tax jurisdiction. The only way to fully escape is to renounce, and which can trigger an exit tax on all your unrealized gains if you sold everything the day before you left. So what strategies actually work? Well, if you're not an American, you can establish genuine residency in places like the UAE, Malaysia, and Singapore, but you're going to have to reside there for over 183 days or more and cut ties with your old tax residency. Another option is called holding period optimization, where if you're holding for over a year, you can significantly reduce your tax obligation. Another one probably is called tax loss harvesting, where you can sell losing positions and offset gains. Another thing is, I think the wash sale hasn't historically really applied to crypto, but maybe the IRS might be changing its mind. You might also consider retirement accounts like a self-directed Roth IRA, where crypto can grow tax-free. And some use corporate structures in favorable jurisdictions, but this is going to require some real substance, like a real office and employees. It's not just a DIY strategy. Regardless of your strategy, if you don't report properly, you're risking everything. If you hold over at least $10,000 in foreign exchanges, you must file what's called an FBAR, or risk penalties of up to $100,000, or even 50% of your account balance. You also have FACTA or FATCA. You also have Form 8949, and Schedule D for every swap or sale. They have software out there like Coinly or CoinTracker can automate this process because this is very vital, while the IRS is using blockchain analytics to prioritize enforcement. The hardest tax questions involve decentralized finance. When you provide liquidity or stake or bridge assets, the tax treatment is often unclear. But in the US, staking rewards are generally taxable as income when received. But guidance on wrapped or rebasing tokens remain kind of thin. My advice is to take a defensible position. Document your methodology, and work with a CPA who understands crypto. Smart planning can save you a fortune. So start with the rules, build a strategy, and never skip reporting. Even if you want a deep dive on a, let's say, specific country, drop it in the comments, and don't forget to like and subscribe. And also, stay healthy, wealthy, and wise, and I'll see you in the next one.